Thanks for joining David, Kevin, and myself for the market update for the month of September. We hope you and your families are doing well. Lots of things are going on in the market, and David and Kevin are going to explain what happened in September. As always, though, if you have any questions, need anything, please don't hesitate to give us a call. Take care.
Global equity markets were quite volatile in September, ultimately ending the month firmly in negative territory. We saw the S&P 500 in the United States down 4.87%. In Canada, we fared a little bit better, but still the TSX was down 3.7% in September. And globally, the MSCI World, which is an index that sort of tracks global stock markets in aggregate, was down about 4.45% for September. We also saw yields, so interest rates, real interest rates rose again in September. And that affected bond prices once again. Bonds traded down a little bit in September. The FTSE Canada Universe Bond Index was down about 2.6% in September. We also saw gold fall, which is traditionally a safe haven asset. It was down 5% in September. And the loonie depreciated about 0.5% against the US dollar. So there really wasn't a whole lot of places to hide outside of cash for Canadian investors in the month of September. Kevin, what was driving the market lower this past month?
There was a couple of factors at play last month. Continued stronger than expected economic output in the US helped drive yields up once again. And investors are now expecting that these higher interest rates are going to remain higher for even longer than thought just a couple months ago. Energy prices for gas and oil were up substantially in September. And now energy costs are not easily controlled by US monetary policy, meaning raising interest rates isn't going to help lower the cost of energy. And so this was a concern for the market, as a spike in energy costs will prove inflationary. Even though we did see headline inflation tick up a notch, the Fed's preferred inflation gauge, the core personal consumption expenditures, which removes more or strips away more volatile items like energy, did ease from 4.3% year on year to 3.9% in August. And finally, with any possibility of a shutdown of the US government for any period of time on the table, this is going to add to uncertainty and concern within the markets, which is what we're seeing.
Much of 2023 up until now has been pretty smooth sailing. In fact, the first half of the year was pretty stellar, and unfortunately in the past couple of weeks with the negative markets, client portfolios have given back some of the gains that they've earned year to date. But overall, when we're looking at client portfolios, pretty much everyone's still positive here in 2023 overall, despite the recent setback in the markets. Now, we've been speaking with some clients, and understandably, some people are beginning to feel nervous again, that there's going to be a bigger drawdown ahead. And while this certainly may be the case over the next month or two, nobody knows what's going to happen in the short term. Just recognize that, again, your portfolios are being managed on a day-to-day basis actively by the best portfolio management companies in the world. And so every security that you hold is constantly being reevaluated. Is the stock profitable? What are the prospects long-term for the stocks that you own? From an asset allocation point of view, if stocks have reached full value by the models that these analysts use, sometimes they get sold and they sit and hold cash for a while. In balanced portfolios, many balanced portfolios in recent months have been allocating a little bit more into safer short-term bonds because yields are so high currently. So on a day-to-day basis, just rest assured that your portfolios are being looked at. And if larger scale changes are ever needed, Harry, Kevin, or I would give you a call, of course. But the purpose of reiterating that is just to let you know that we are close to the end of this investment cycle and a new one will begin. And when that does, by investing in the things that we have you in, we know for sure that your capital will be preserved. Doesn't mean that from week to week, month to month, it can't have a negative result. But it will be preserved for when the next investment cycle begins. And that's the main thing at this point in the game, is getting to that next point where the market's going to eventually turn because inflation will come back down to target. Interest rates will begin to eventually moderate and stabilize. If not, we'll eventually see interest rate cuts too. And in that context, that's when the next investment cycle can begin, and you want to be in the game for when the next market starts and we start to see that positive momentum and gains start to occur month over month and year over year once again.
As always, if you do have any questions or concerns and want to talk to Harry, David, or myself, give us a call. We'd love to chat with you or have you come in and possibly do a financial plan update as well. Take care.